Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing the Williams Company stock so we can determine if it's a buy or a sell. The Williams Company's core business is natural gas processing and transportation. An interesting fact, the company helped to get the modern telecommunications industry off the ground by running fiber optic cable through its decommissioned pipelines. It built two nationwide networks, which subsequently spun off into separate companies in 1995 and 2001. The company is headquartered in Tulsa, Oklahoma, and was founded in 1908. Let's get started with the model. This is a large cap company, 36 billion market cap. They're trading at $29 a share, and they have 1.2 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow in 2019 was $1.5 billion. It jumped up 50% in 2020 to $2.2 billion, then jumped up about 20% in 2021 to $2.7 billion. And then it's pretty flat in 2022 at $2.6 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was $700 million in 2019. It dropped to $200 million in 2020, then jumped way up to $1.6 billion in 2021. Then another big jump in 2022 to $2.1 billion. Revenue is the sales for the company, and that dropped from 2019 to 2020. Then grew about 50% into 2021, over $10 billion, and it's close to $11 billion in 2022. They recently released their first quarter earnings, and this is their first quarter income statement. Revenue of $3.1 billion. In the first quarter of 2022 is $2.5 billion, so it's up about $500 million. $1.7 billion from service revenue. This is delivering the gas through its pipeline. And then product sales is $845 million. And they had a gain on commodity derivatives, $500 million. Last year they had a loss. They have to buy the oil. That cost them $550 million. It cost them $54 million to process the oil. Operating and maintaining the pipelines, $460 million. Depreciation and amortization, $500 million. SG&A, $176 million. So total cost and expenses, $1.7 billion, down from last year of $1.9 billion. Their operating income is up a lot from $650 million to $1.4 billion. Their earnings from investments in other companies, the accounting term is equity earnings, that was $147 million. They paid $300 million of interest on their debt, similar to last year. $284 million of taxes, so their net income is $957 million, up a lot from last year of $400 million. Their earnings per share were 76 cents, up from 31 cents. And they have 1.2 billion shares outstanding last year and this year. They do have 3 million more shares this quarter when you compare it to the same period last year. This is the operating section on their statement of cash flows. And the way to calculate operating cash flow, you start with your net income, $957 million. Then you add or subtract the non-cash items on the income statement. We add back depreciation and amortization, $500 million. We have to minus out the $147 million gain on equity investments. But they received $208 million of dividends from those equity investments. That's a cash inflow. They also had a cash inflow from accounts receivables, $1.3 billion. So they sold items on credit in a prior accounting period. And in this quarter, those customers are paying for those items. It looks like they had to pay back over $1 billion of accounts payable, so they bought items on credit in the past and are paying it back this accounting period. And accrued liability, this is when a company has incurred an expense but hasn't paid it yet. So it looks like they took out that liability in the past, so it was a cash inflow then, but in this accounting period they're paying for it, so it's a cash outflow of $318 million. Even though they reported a $957 million accounting profit, they actually generated $1.5 billion of cash flow. Last year, they generated $1.1 billion of cash flow. Let's look at the capital structure. $11.5 billion of equity, $23 billion of debt. They're 33% equity, 67% debt. Their net debt is $22.8 billion. So they only have $150 million of cash on their balance sheet. I gave them a whack of 10%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $43 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $38 billion. We divide that by 1.2 billion shares. And we get a calculated stock price of $31. They're trading at $29, so they're trading at a 6% discount. It's a buy according to the model. Simply Wall Street is at 28. They say the stock is 5.5% overvalued. 15 analysts price this stock, and the average price target is 37, the lowest 31, the highest 42. Another 20 analysts price this stock, and the average price target is 36. They say the stock is 25% undervalued. This is where the stock has been trading since 93. It did IPO well before 93. The stock was only about $7 in 93, and then it ran up close to $40 in 99. And then in 2001, 2002 was a dot-com crash, and oil prices did come down. It looks like it got really low, down to about $3. Then it ran up past $30 over the next 5 years, and then in 2008, the Great Recession, and the stock came back down to below $10. And then there was a huge bull run. Over the next 5 years, it got close to $60. And oil really crashed in 2015 and 2016, and the stock fell to about $14 in the beginning of 2016. By 2018, it did break through $30, and was trading around $25 when COVID hit. Then it fell to about $12. Then over the next 2 years, it jumped way up to about $37. It has been retracting over the past year to about $30. They've been paying a quarterly dividend for a really long time, and they seem to raise it every year. It was 34 cents in 2018. It's up to 45 cents currently. That's a yield of 6.1%. which is 84% of their free cash flow, 103% of their net income. There are 52 companies in the same industry as Williams, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They spend a good amount of capex, $2.5 billion. Their debt to equity ratio is between the median and average. Their yield is equal to the average, but lower than the median. They generate lots of free cash flow. They rank 6th in market cap. All their price multiples are worse than the median, but their price to book is better than the average. But their PE, price of free cash flow, and price of sales are worse than the average. They generate a little more revenue than the average company, and their 5-year annual revenue growth rate is only 7%. The average is 16%. So to summarize, I have them trading at a 6% discount. And this company has a really long history, been around 115 years. So it probably will be around after we die. So just put all your money to this stock and collect the dividend. I don't know if I would suggest that, but they do seem to be generating pretty consistent amount of free cash flow, and their revenue is strong. I rank their free cash flow 6 out of 10, their revenue 7 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.